Hello, everyone. We're so glad you've joined us today for what promises to be an informative and surprisingly fun journey into the world of Delaware Statutory Trusts. Yes, you heard me. That's right, fun and DSTs in the same sentence. I'm Geri Stern, a realtor for over 30 years in the Bay Area and currently with Compass in Berkeley. And whether you're a seasoned investor, a 1031 explorer, or just a DST curious person, you're in the right place. Think of this as your backstage pass to a smart, tax-deferred investment strategy that many people wish they knew about sooner. We'll be interviewing Paul Getty, President and CEO of First Guardian Group, a phenomenal DST company in the Bay Area. Paul brings years of experience and a wealth of knowledge in this area. Together, we'll demystify the DST, break down the benefits and potential pitfalls, and give you tools to decide if this unique vehicle could play a role in your wealth building journey. So grab your favorite drink, settle in, and get ready to learn how passive income and portfolio diversification can actually go hand in hand with less stress and more strategy. So let's get started. Paul, do you want to tell us a little bit about yourself and what a
Yeah,
DST?
just a little. Thanks, Jerry, for that great introduction. My company, First Guardian Group, has been in business 22 years. We work with real estate investors and also agents and brokers like Jerry all over the country. Our clients are in the thousands and they're from all over the world now. We started off in the Bay Area 22 years ago, but people have moved around. And at this point, we're dealing with not only our original clients, but in some cases, their kids, and in some cases, the grandkids already. So time flies. My own background's a little bit unusual in that I had my first rental property when I was 14 years old. I come from a long line of real estate investors going back several generations, and I was kind of taught real estate at the ripe old age of 14, where I was kind of required to become a landlord for one of the holdings in my family's portfolio. So that's the short story of my background, Jerry.
Wow, that's pretty unique, Paul. Pretty young. You've had a lot of experience since then. So why don't you start us off with telling us what is a Delaware statutory trust?
Well, a Delaware statutory trust is just another structure for owning properties. Many of us, when we acquire rental properties, we either own them as a sole proprietor, we may own them in an LLC, we may own them in a trust. And the Delaware statutory trust is simply another way of owning them with some unusual benefits. The Delaware statutory trust that we're going to be talking about today, the form of it was actually created back in 2004 by the IRS. And the reason it was created is that when we're doing the sales of rental properties, we often want to try and minimize taxes that are due when we sell properties, particularly properties that have appreciated. And so one of the challenges is in order to do the reduction of taxes or the deferral of taxes, we are struck with the responsibility of finding a replacement property. Finding a replacement property can be a real challenge. So the IRS, in all their great wisdom, came up with this alternate structure, which is a way in which multiple investors, potentially several hundred, can acquire a piece of real estate, income producing real estate, and then share that ownership amongst themselves. So it's a fractional ownership model that qualifies for 1031 exchanges. It also has a management component to it where investors in the DST structure are not required to manage the DST. That responsibility is given to the DST manager, who's called a sponsor company, and they're responsible for the day-to-day operation. So as an investor, it's a passive investment for the most part. It's kind of like investing in a mutual fund, if you will, but it's exclusively related to investment properties.
Can you describe the difference between a DST and an REIT?
Sure. When we own DSTs, we actually own real estate. We own a fractional interest in a property, but it's equivalent to owning title in a piece of real estate. Why that's important is that when we own real estate, at the end of the year, the income that we receive, we put it on our tax schedules. It's called a Schedule E. And on that Schedule E, we're able to take various deductions and potentially reduce our taxable income to a very low level. That's really, really important. And then also, when we sell real estate, or income producing real estate, we can take advantage of the 1031 exchange tax code to defer and potentially ultimately avoid taxes. When we own a REIT, the common thread is that both of these things end with the word trust. So Delaware Statutory Trust, real estate investment trust. But the REIT is a very different kind of an animal. A REIT is a company that owns real estate. So when we invest in a REIT, we're actually investing in shares of stock in a company that owns real estate. And in a sense, we kind of indirectly own real estate, but we don't get all the benefits that we would otherwise get in directly owning real estate. We own shares of stock. We can buy and sell shares of stock in those structures, but it's a share of stock that we own. And importantly, we can't do a 1031 exchange when we sell those shares of stock. And if the stock is appreciated, we have a capital gain that cannot be deferred because we, again, can't do a 1031 exchange when the REIT shares are sold. A lot of people are given the advice, well, if you want to invest in real estate, invest in a REIT. That can be good advice, but the advice has some caveats in that you're going to be taking on additional tax liability.
Yeah, I think a lot of people get those two things confused and they think they're very similar, but totally they are not. So that brings me to a question that a lot of my clients ask me, and that is, how risky is a DST compared to buying another investment property?
Well, like all investments, particularly investments that have intermediaries and managers involved, DSTs have risks, and those risks are not unique to the DST structure. Investing in any real estate has risks because none of us have a perfect crystal ball. Often we pick a piece of real estate in a nice location, and the location specifics change over time. We get impacted by storms, we get impacted by crime, we get impacted by changing regulations. And all of those real estate risks are present in DSTs. The risks can be mitigated to a great degree, however, because when the IRS created the DST, they also required the DST companies, the sponsor companies that I alluded to earlier, to disclose their full track records. That's really critical because anytime we're investing based on the advice of an individual, you really want to understand the background of that individual and specifically the DSTs or specific investment products that they're recommending. How good are the managers of those products? So in the DST world, we are given an opportunity to look at the track record of the sponsors. And if the track record shows, consistent returns, very few DSTs that have not produced what they're producing, it gives you a comfort level that maybe the next ones will be good, realizing, of course, that history doesn't necessarily repeat itself. On the other hand, if you're looking at a DST sponsor and you see continued missing of distributions and other issues in their background, obviously that's something you should avoid. So looking at the track record is the first step. The other step is that when you're looking at DSTs, you have access to a wide range of different types of asset classes. It could be apartments, it could be senior housing, it could be student housing. And of course, they're located in different locations throughout the country. So you can look at places that people are moving into and maybe conclude that those places for residential properties might be better than investing in areas that people are moving away from. So the combination of looking at the track record, the type of an asset that it is, and where it's located are the ingredients that we use to basically mitigate the risks. And then furthermore, DSTs typically have small minimum investment requirements, usually around $50,000. So if we're selling a property, let's just say that the net proceeds are $300,000. In the normal world of real estate, we would probably need that full 300,000, put it in a single new investment to complete the 1031 requirements, and we'd have to kind of ride with that all eggs in one basket strategy. In the DST world, we could split that 300,000 up and then mitigate the risk of riding on a single investment. And that's another factor that a lot of investors take advantage of. But again, I'll conclude, DSTs are not guaranteed. They're not risk-free. You need really the advice of a good advisor to help you look at all the DSTs that are available if that's the direction you want to go, and rely on their advice and your own common sense to make the decisions that ultimately will lead you to make the investment.
I have a follow-up question to that. Can anyone invest in a DST, or do they have to have a minimum net worth?
Well, that's a great question, Jerry. And the answer is yes, a minimum net worth requirement is required by the IRS. And that minimum net worth requirement is that the individual has to have a net worth of $1 million or greater, excluding the equity in their personal residence. And that means bank accounts, it means rental properties that they own, it means personal boats, cars, gun collections, coin collections, anything they have that is outside of the realm of their personal residence or second homes, places where they live. If that totals to $1 million or greater, they can then look at DSTs as a potential option. If they don't hit that net worth requirement, they're then in the world of traditional real estate. They would be looking at, the same kind of real estate that I owned when I was 14 years old. I didn't have that kind of net worth at that time. So I was in the world of traditional real estate. But if you can get up to the point of being what's called an accredited investor, which is that $1 million or greater threshold, you can also meet that by making $200,000 of income or greater per year if single, or $300,000 if married. So it's either an income test or a net worth test. And if you meet those tests, you now can begin to look and consider DST investments.
I think that's a really important point because it's not for everybody, especially in different parts of the country where they may not have that income threshold. So someone asked me recently, could you invest in a DST if you're not doing an exchange? Can you just take some money in the bank and invest for a good rate of return in a DST?
I would say about 20% of our clients invest cash in DSTs, and they do that to get a good return. The returns on DSTs in today's market are in the range of 4 to 6, potentially as high as 7% on a cash flow basis. And again, that income can be reduced through deductions that you can take because it's income from real estate, which is more favorable for many investors than income from dividends or stocks and bonds, which are taxed, generally speaking, at a rate where you can't take as many deductions against that. So we like real estate income. 5% of real estate income versus 5% of income from stocks and bonds is often better because the after-tax money that you put in your pocket from real estate income can be greater. So that's a direction that we go. I would say the other thing that's kind of interesting, a lot of people hear my story about my family kind of forcing me to get into real estate investing and being a landlord when I was 14 years old. And they want to find ways to encourage their kids to go down the same path. Well, today, what does an average investment require? It requires hundreds of thousands of dollars in most markets. But for $25,000, you can buy a portion of a DST if it's a cash investment. If it's a 1031, it's going to be about a $50,000 minimum. But for $25,000, you can acquire a DST and then give the responsibility of watching over it to your kid and have them, much like I did, learn real estate, based on a fairly modest investment. So that's another reason that people invest in DSTs.
Would that same $1 million threshold apply if you're just investing cash?
Well, yes, it does. And the way that it was conveyed to me when I was 14, because I wasn't an accredited investor, nor were DSTs around at that time either. But what my current clients do is that they acquire the DST in their name or in the name of the trust. So when they acquire it, it's an accredited investor that's acquiring it. But they then in their trust or their discussion with their kid, they say, you're now responsible for this. You're going to get all the benefits of it. You're going to get the management reports. You're going to be doing the taxes on this at the end of the year. So they basically give their child all of the responsibilities, which now results in them getting an education on at least one aspect of real estate investing that it can be very, very, important in terms of a wealth creation model.
Wow, that's something that I'm sure most people have never even considered.
Sure.
And I think that's really valuable information. Thank you for that. So if another question that's come up is clients ask, well, how long do I need to stay in the DST? Are there any time limits? What if I need my money in an emergency? How hard is it to get out? Because if I had a rental property, I might be able to sell it right away.
Sure.
So
Well,
how would you answer
that's one of
that?
the downsides of the DST because when we enter into a DST investment, we are passive, meaning we can't call the manager up and say, "Hey, I want to sell my interests today." The holding period for most DSTs ranges from 6 to 8 years. There's no legal limit, but typically the sponsors that create the DSTs, they want to hold the DST long enough to provide a really, really good return to the investors. and they want to sell at some point to encourage the investors to reinvest with them. Why? Because the sponsors typically make most of the money that they make in causing people to come into new DSTs. They don't make a lot of money during the holding period. They don't do any profit sharing on the back end. So their mission in life is to do a really good job for a relatively short amount of time, 6 to 8 years. Let me contrast that with normal real estate. When we do a 1031 exchange into a single family rental that we control and we're the owner, we typically have to hold on that investment for a minimum of 2 tax years. I teach a lot of CPA classes, and while that 2 year time limit is not well defined in the tax code, most tax advisors will say hold it for 2 years. In contrast, let's say you and I were flipping homes in Los Angeles, Jerry. We buy a home, fix it up 6 months later, sell it. We couldn't do a 1031 exchange because we would not be meeting that 2 year threshold. So that's really critical. But after 2 years, you could potentially resell your DST interests to another investor. We provide that service to our clients, as a matter of fact. So we have, in a sense, kind of a little bit of a secondary market. It's rare that people do that, but occasionally situations come up. The most common one is that an older couple, maybe one of the spouses would pass, and the remaining couple would get what's called a step up in basis. Because in the tax code, and many of the listeners may not know this, when we have a passing of a spouse, the remaining spouse, particularly here in California where we have community law property held, the remaining spouse picks up that property as if it were valued at the full market price of the day the other spouse passed. So all of the capital gains taxes that we're otherwise worried about deferring are essentially forgiven on that day. And so occasionally the surviving spouse will call us up. It's usually the wife, to be frank, and we will then talk about, basically liquidating those DST interests so that the remaining spouse could enjoy the tax-free cash that would come out of that. But again, it's rare. Most investors that get into DSTs should not get in with the view that they're going to park money for a while and get out of it. They should consider the investment to be illiquid and to be in a holding period of 6 to 8 years.
So I was told that if you go back after 2 years, you might not be able to get your full investment back because for whatever reason. Can you talk a little bit more about
Well,
that?
sure. Again, whenever we sell a piece of real estate, it's going to be subject to market conditions at the time of sale, and the DSTs are just like that. So when we or an investor attempts to resell, they're not going to have as broad a market in the resale area, because if you're selling traditional real estate, you're typically going to have a really good real estate agent exposing that property to potentially hundreds of potential investors. In our case, we would be exposing it to the investors that at that time had a 1031 requirement, and it's a fairly limited market that we would be exposing it to. So it's going to be subject to marketing. If the DST is performing well, the investor should have a good outcome. But if the DST, perhaps the distributions have gone down, maybe there was a change in insurance premiums or something happened that caused the distribution rate to go down, potentially there could be a negative impact on getting the principal back. That's why most investors are encouraged by companies like ourselves to stay in the investment until it fully matures, until the sponsor decides to sell it. Also, sales of DSTs that are done early, typically it's hard to gauge the amount of appreciation that may have occurred in that DST because there's no formal appraisal that's taken place. So for those reasons, I think it's fair to say that there's a greater risk that investors will not get their full principal back if they sell early. There are exceptions on both sides of that, but I think the expectation is if you get out early, you may have a challenge in getting 100% of your investment back, and you will have a difficult time marketing it unless you're dealing with an advisory company that has a large installed base of people that are doing 1031 exchanges.
So thank you for that, because that's very important. Um, so when someone comes to you and they are a complete novice, but they get excited about, oh, you said I could get a rate of return at 7%. So isn't it the case or the rule that if the higher the rate of return, the greater the risk? And what might some of those properties be that are at the higher end, and what might those risks be?
Well, that's absolutely true. So I think in every time we look at an investment, I think it's always good to keep that the greater the risk, the greater the reward. That's not always true because there are exceptions to these rules, but in general, that is true. When we look at real estate investing, I want to make an important point. There's really two buckets of returns that most of investors look at when they're investing in real estate. One is the ongoing cash flow that we get from the properties, which is in that range that I gave you, the 4 to potentially as high as 7. And I'll answer your question about what's in the 7% category in a moment. And then the other part of that is the appreciation. In California, for many years, most of us that bought properties in California, rental properties, really didn't get much income. In fact, we may even had negative income where we would have to feed the property for a period of time. Why? Because we were hoping for the appreciation on the back end, because historically, California, as an example, has been a marketplace where properties have appreciated. Many of us have bought a property for $100,000 maybe 20 or 30 years ago. That property may be valued at $1 million today, right? And even though the income along the way may have not been that great, the appreciation has been quite handsome. That's changing for many reasons. The biggest reason that in a lot of areas like California, people are actually not as excited about moving into California. In fact, we're getting negative population growth in California. So the areas for appreciation have shifted from California to other parts of the country. So let me get back to your question. The most secure investments that we have among the range of asset classes that are available, first of all, are those that are offered by sponsors that have longstanding track records. So track record, extremely important. The second thing is we look at assets within the scope of real estate that are necessities, that are things that people can't do without. And I would share with you that when I was learning real estate from my dad, I asked him the same question. And his answer was, Paul, I lived through the Depression. And if I had $2 to my name, $1 would go to put food on the table. The next dollar would go to pay the landlord so that the family could be sure to have a roof over their head that night. The takeaway from that lesson was that if we stick to necessity real estate, which is essentially, for the most part, the thing that we need the most is beyond the food that we eat and our health, I guess, is the place where we live. So residential real estate, whether it's a single family rental, or an apartment, or maybe it's senior living, which is another category of things that we live in. Those are categories that have done really, really well. At the other end of the spectrum are things that are more volatile and more risky. And I guess the example that I give you, I'll give you a couple, several, would be a hotel. So
Mm.
hotels during good times can do well, but as we all saw back in the 08, 09 recession, Las Vegas is an example, which lives on the tourism industry for the most part, almost tanked because people were not traveling. The hotels were empty, and those that had hotel investments were not getting income. In fact, in many cases, they may have lost money that they've invested. The same thing occurred during COVID. During COVID, people were not traveling. They still had to have a place to live, so their apartment bills were typically being paid. But the hotels, the travel, student housing is in another category that also is susceptible to policy changes by universities. So there's categories like that that because of the higher risk, they often have a higher initial distribution rate, but that distribution rate can be subject to more volatility and potentially, a reduction in distributions. 7% DSTs are among the riskier right now. They involve, in some cases, investments in raw land, where a
Oh, that
sponsor
can be really tricky.
well, it can be really tricky. And why would you want to invest in raw land? Because there are a number of sponsors now that are setting aside tracts of land for future development. And as long as the housing market, remains robust, and there'll be houses built on that vacant land 3, 4 years out, that might turn out to be a pretty good investment. But also, since none of us have a perfect crystal ball, if the economy tanks, if interest rates go up again, and home building declines, we're going to be sitting on something that's unfortunately not going to be producing the outcome that we hold. That's another reason for asset allocation. So if folks want to push a little bit of money in a higher risk asset, they should, in our view, really have that balanced with a greater amount of money in safer investments among those asset classes and those sponsors with great track records in areas that are not likely to have the kind of ups and downs.
Well, let's dive a little bit deeper into how something at 7% return might work. If someone invests in a piece of land per se, and they that land isn't producing any income, doesn't have rental income, it doesn't have, anybody obviously paying them for that land after it's been paid for. How do you get 7% and a year, and how is that paid? Is that paid monthly? What is that based on? How does that work with a
Well, all the DST incomes are typically, when I say, 4, 5, 6%, those kinds of numbers are annualized numbers, and you're typically getting a distribution payment monthly, monthly. So it's 1/12 of that. And in the land deals, you're right, they're not producing income, but the folks that have bought the land have set aside enough money to basically pay that 7% for a given amount of time. That's not for an infinite period of time. So again, there is a risk that that money might run out if their plan is to sell the land or develop it into single family homes, let's say in 3 years, and the market sags, and now we're in years 4, 5, or 6, that income could dry up. That income could dry up and go away. So that's the risk of the higher returns. I would say also pre-COVID, the highest returning assets that we had in the industry were hotels. Often they would also be in that 6, 7% kind of a number, but when we explain the volatility of hotels to people and they kind of, oh yeah, I understand that now, they would back away from that. And even if they like the hotels, rather than putting a lot of their money in that, they would diversify into other assets like apartments or other residential properties to offset that. There's also another category of investing that catches the interest of a lot of people, and those would be triple net properties where you have now a company like an Amazon or a Best Buy guaranteeing the lease payments of that particular piece of property. Those are called triple net properties or net lease properties because in that format, the tenant is ostensibly responsible for paying the taxes, the insurance, all the related expenses of managing that property. And provided the company behind that is a high quality company like an Amazon or a company with a high credit rating, those could also be very, very reasonably less volatile, more secure investments.
Would those typically pay like 3 to 4%, something in a triple net?
No, they actually pay, in that 4 to 5% range. They're not at 7% because they just don't have the risk profile. They're more secure, but the downside is they don't have as much upside in terms of rent appreciation. Why? Because the triple net leases typically inherently have a lease increase limitation of typically 1 to 2%. Occasionally, you might see a 3%. That's per year. So if you're in a period where inflation is higher than that, and inflation is coming down, but obviously for the last couple, 3, 4 years, we've had inflation at elevated levels. Hopefully it does come down. But if you can only raise rent 1 or 2% a year, you're not going to be catching up with the deterioration of the dollar that's occurring during inflationary periods. So you're not going to get as much appreciation. Why? Because when income properties are sold, one of the greatest determiners of the value of that income property is the income that it's generating compared to the income of all other properties that are available at the time of sale. Apartments are typically able to raise rents quicker because the leases are often month to month. They aren't limited by a long-term lease such as you'd see in a triple net property. So the appreciation that we see in apartments, because you can raise rents more aggressively, subject to market conditions, often leads to greater appreciation in those types of assets relative to triple net.
So that's really interesting. I had a situation come up where an investor called me and said, I have property in an investment in a DST in an area where there's rapid increases in insurance payments because of floods, fires, etc. And the company is warning me that they may need to reduce my monthly payment because they're going to have an increase in their insurance costs. How do you work with that? Do you help out clients who are then going to have a monthly income decrease when they weren't expecting it?
Well, again, there are some assets where the protection on price increases, whether it's due to insurance premiums or other, property taxes going up, where that's somewhat protected. And that would be again in the triple net category because the triple net client or the tenant is responsible for those things. They have to pay the increasing price of insurances, property taxes, et cetera, et cetera. The offset is you might get a little less appreciation in the investment of those. On the other hand, if you're investing in residential, while there is the potential for more upside, particularly in a strongly growing area, you also, as an owner of that property, are bearing the risk of increased insurance costs, insurance property costs. So you really have to do your homework to make sure that the insurance companies and the insurance policies are going to be in place. What has happened in the last couple of years, we've had some elevated storm damage. Clearly, the East Coast was impacted by hurricanes. We had the fires down in LA, and those events have caused insurance policies, particularly from U.S. carriers, to go up. What I am seeing, though, is that a lot of overseas carriers like Lloyd's of London has started to jump into the U.S. market. And because Lloyd's of London, is one example, is an international company, they're able to share their risk pool over the entire planet. And they've been able to kind of lower insurance rates as a result. But one of the risks of investing in residential is the risk of heightened costs that you can't necessarily predict in advance because sometimes things happen. The triple net asset classes that I just spoke about earlier are more insulated from that risk. But again, real estate has risks, and one of the risks is rising costs beyond what you initially foresaw as an investor.
Yeah, and I mean, just owning real estate in general for anybody, buying a house, you never know what's going to happen and how much maintenance you're going to have coming up, insurance, things happen. It's just property taxes go up. It's a lot of
Right.
fun. Um, yeah, well, you've covered a lot of territory here. Is there anything else that you think that people might want to know? I mean, I think the last question I have is if someone has a living trust, can they purchase these DSTs in the name of the trust, or do they
That's very common. Yeah, that's what my parents and grandparents and great grandparents have been doing. We like holding properties in a trust because within the trust structure, there are a lot of instructions that are in that trust document that if something were to happen to us, hopefully our heirs or kids would then go to the trust document to know what to do, who to contact, and there would be instructions there. What if we become incapacitated? We would want to give instructions to those around us. Here's what to do if Paul, for some reason, can't continue to do what he was doing earlier in his life. So owning a property in a trust is another structure. And again, the trust can be an envelope to put DSTs, to put LLCs, to put all kinds of ownership structures. It's kind of an envelope that wraps around all of our investments and all the things that we own to give proper instruction to those around us in terms of what may happen if we're no longer able to manage the investments on our own. I would like to close with one important thing, and that is I've been fortunate to write a book that a lot of people kind of look to as kind of one of the best sellers, kind of the Bible of the DST industry, if you will. That's not my characterization of it, but that's what other people say about the book. It's available on Amazon for about $30. But if you go to our website, which is www.fgg1031.com, again, www.fgg1031.com, you can get a free download of the book. And there's also an audio book of the previous version of this, which came out a few years ago. This is a new revision that just came out a few months ago. It's already a bestseller in this category. And I would encourage people, the first step of really learning about any investment is education, education, education. You're in good hands with Geri. I think the first step also is to meet with her if you have a rental property and determine if a DST is something you should even be thinking about. You may really be wanting more to look at something in your own backyard. Maybe a traditional rental property would be a better fit for you. On the other hand, if you're looking to get in more passive investments and look at DSTs more thoroughly, my book would be a good next place to go. And of course, I'm certainly available to get on Zoom calls or phone calls with Geri and her clients, almost at any time that's convenient for everyone to answer specific personal questions about what they may want to do. And if you're selling a property and you're already at a point that you want to take a deeper dive in what's available, we can certainly provide investors with lists of DSTs that are available at the time they plan to sell.
Yeah, that's a good point. And I wanted to end on this. A lot of people are reluctant to sell their rental properties because they can't find a property locally that
Sure.
is affordable or even available within the timeframes that they need it. And the fabulous thing about DSTs is, and correct me if I'm wrong, you always have something available on the
Yeah,
moment for people to get into. It may not be necessarily their first choice, but it's going to be a pretty good decision that they could make rather than paying capital gains.
sure.
Is that
We
correct?
typically have as many as 60 DSTs that are available. And again, I would just hasten to say we don't categorically approve all DSTs in the country. There's probably more than 60 DSTs in the country that are available today. Our company and our brokerage company scrutinizes all the DSTs that are out there. And if they pass our fairly rigid requirements, we then are able to expose them to clients. But just like everything, not all investments are created equal. Not all DSTs are created equal. There's some that meet our test and that we're able to expose to clients, and there's others that we pass on.
Thank you. Well, this has been fabulous. I really appreciate your time and all of the information you provided. It's been really enlightening for me. I've learned a lot. So if anybody needs to reach either Paul or myself, just give us a call and we'll have our information available to you as quickly as we can. Thanks a
Thanks,
lot.
Jerry. Appreciate it. It was fun. Bye now.
Take care. Bye, Paul.